There is something else that's also run by the Social Security Administration, and it's got a confusing acronym. It's called SSI. That's Supplemental Security Income, and that is not part of the Social Security system, even though it's run by the Social Security Administration. That is a small stipend, and I think it's not much. I think it's $300 something per month for people who are over 65 and don't have any other source of income, not even Social Security. So if you don't qualify for Social Security and you're above a certain age, you can get supplemental security income. And that is considered a welfare benefit because it is based on an income test. And welfare benefits are never taxable. So SSI is not taxable. But SSDI, which stands for Social Security Disability Income, is possibly taxable, just like any other Social Security benefits. Okay, this is what a SSA 1099 looks like. And when you are receiving Social Security benefits, you'll get one of these at the end of the year by January 31st, as long as Social Security knows where your address is. And this is what you'll use to help prepare your tax return. On the actual 1040, we have Social Security benefits on line 6A, and this is the total amount of your Social Security benefits. And then over here on line 6B is where you report the taxable amount. And we'll show you in a moment how to figure the taxable amount. We also have, very rarely we'll see something called an RRB 1099, and this is Railroad Retirement Benefits. And actually I haven't seen more than one or two a year, so we don't really have to go into much detail on this, but RRB 1099 is treated for tax purposes the same as Social Security benefits.
I hear you get benefits from people working around.
Yeah, there's actually two different 1099s for railroad benefits. There's an RRB 1099 and an RRB 1099R. And one is for the equivalent of what would have been Social Security benefits and is treated for tax purposes the same as Social Security benefits. And then there's additional or tier 2 benefits, which would be more like an employer-sponsored pension. And that's going to be equivalent to any other pension or retirement plan that we're going to see later on in this chapter. But right now we can just focus on the SSA 1099. And there's some worksheets to help us decide how much is taxable. The main thing, and there's actually a worksheet on the back of the SSA 1099 when you get it from the Social Security Administration, but it's a much simpler worksheet. But basically the idea is some percentage of your benefits are going to be taxable if you have other income besides Social Security. And here we have two base amounts, a first base amount and a second base amount. And that base amount is going to depend on your filing status.
So this is Social Security income?
Yep, this is Social Security income. Well, these are base amounts, and this is what you do is you take half of your Social Security benefits plus all of your other income and take that total and compare it to these base amounts. So if I were collecting $25,000, let's say I've retired, I'm getting $25,000 in Social Security benefits, and I'm also getting a $20,000 pension. So half of my Social Security benefits, half of $25,000 is $12,500. Add in my pension of $20,000, that's $32,500. Now we look at this chart, and based on the fact that I'm single, we see that it's more than $25,000, but less than $34,000. And based on this chart, up to half of my Social Security benefits are going to be taxable. There's actually a full worksheet coming up. Right here. And the worksheet looks pretty complicated, but it's like many IRS worksheets. If you go through it step by step, it's not actually that difficult. It's just tedious. But the way this works is, let's say I have $25,000 in Social Security benefits, and I have $30,000 in other income. That could be pensions, that could be rental income, could be that I'm still working while collecting Social Security. Doesn't matter where that income comes from. It's all my other income. So if I have $25,000 in Social Security benefits, I take half of that, which is this $12,500, then add that to my other income to come up with a provisional income of $42,500. Now, if that provisional income is less than the first base amount, which is $25,000 single, head of household, or married filing separately, or $32,000 for qualifying widow and married filing jointly, if it's less than that first base amount, none of my Social Security benefits are taxable. And this is the reason why, when we talked in Chapter 1 about whether you're even required to file a tax return, we don't count Social Security. Because if your income is below your filing threshold, then you don't have enough income for any of your Social Security to be taxable anyway. That's also why we excluded Social Security income when we're talking about dependents and whether their gross income is more than $4,700. Well, if your income is that low that we're worried about whether you made more or less than $4,700, it's going to turn out none of your Social Security is taxable. $4,700 is a huge difference from $25,000 and $32,000. So if it's less than this first base amount, it's not taxable. And if it's more than the second, well, if it falls in between these two, then we basically just subtract the first base amount from the provisional income. So let's change this so it falls in between. Okay, so $25,000 is my Social Security benefits. I have $17,000 in other income. So my provisional income is $29,500. If I'm single, my first base amount is $25,000. And I can just subtract that from my provisional income, which gives me $4,500. And my taxable Social Security is just half of that result. If I were married filing joint instead, since my provisional income is less than the first base amount, then none of my Social Security is taxable. If my provisional income is more than the second base amount, then let's make this 30,000. Okay. If my provisional income is more than the second base amount, then the part of my provisional income that falls in between these, which is $9,000, is the difference between those. Half of that is taxable Social Security, and then 85% of whatever's above that is taxable Social Security. And then it's always capped at no more than 85% of your Social Security income is taxable. So no matter how much Social Security income you have, and no matter how much other income you have, 15% of your Social Security income is always going to be non-taxable. But the main thing to remember, that's all pretty complicated, but the main thing to remember is half of your Social Security benefits plus all of your other income is your provisional income. And if your provisional income is less than the first base amount then none of your Social Security income is taxable. If you're married filing separately, so when I did this, I should have put a little asterisk by married filing separately. Because if you're married filing separately and you live with your spouse even one day during the entire year, then these base amounts become zero, and the second base amount is also zero, which means that automatically 85% of your Social Security income is taxable income if you're married filing separately and living with your spouse. Because to figure your Social Security correctly, I mean, it would be different if you were married filing joint, but you would need to know how much your spouse is earning, because this also counts if you're a married filing joint. So I might be retired, but my spouse is still working, and so I'm getting 25,000 Social Security benefits, and my spouse is working and earning 30,000. Then we're going to apply this rule here and find out that $5,000 of my Social Security benefits are taxable income.
At 85%. At 85%.
No, 5,250 of my Social Security benefits are income, which is going to add on to whatever the other income is. So when I'm actually doing the tax return, and based on the information, maybe I'm married filing jointly, maybe my spouse makes $30,000, and my Social Security benefits are $25,000, and we have no other income. Then I'm going to have to count 5,250 as taxable income, which means when I add everything up, my total income is going to be 35,250. But then I'll still get to take our standard deduction of 27,700. And my taxable income would be 7,550. And then we'd have tax of something like $778 or $758. But part of my Social Security is taxable. If I were married filing separately, though, then 85% of the 25,000 would immediately be taxable. Second thing that's important to mention is, especially when we have survivor benefits, someone's dependents or their children might be receiving Social Security benefits. That Social Security benefits is going to be in that child's name and social number, and those Social Security benefits are actually belong to that child, even though the parent gets to use it however they feel most appropriate. But that is not the parent's income, therefore it does not belong on the parent's tax return. So many people, if they're doing their own taxes, maybe my spouse died and I'm raising 3 kids. And so I might get $12,000 in Social Security benefits, and each of my kids also gets $12,000 in Social Security benefits. Well, if I were doing my own taxes and I didn't know the rules, I might, go on TurboTax and say, I got $48,000 in Social Security benefits. And then TurboTax would say, well, based on the fact that you have $48,000 Social Security benefits, that's pretty high. Who knows, maybe $35,000 of it's taxable income. Whereas the correct way to do it is I only got $12,000. And so maybe $10,000 out of the $12,000 is taxable income to me. Each of my kids got $12,000, but they don't have any other income, except for the permanent fund dividend. So their income is low enough that none of their Social Security is going to be taxable. So by doing it the wrong way, by putting $48,000 into my tax software, my off-the-shelf tax software, I'm paying tax on $30,000 that I shouldn't have to pay tax on. Now, this will happen sometimes. Sometimes you might get a lump sum from Social Security, which is basically retroactive Social Security pay. when you first apply for Social Security benefits, that is, if they determine that you're eligible, the application date is when you're first eligible. Even though it may take some time after you've applied for Social Security to determine you're eligible.
Like years and years.
So especially if you're applying for Social Security disability, it can take several years for them to determine that yes, you do qualify for Social Security disability benefits. And let's say they say you qualify for $14,000 a year in disability benefits. But you applied way back in 2020. So we're going to pay you all of what we owed you for 2020, 2021, 2022, and 2023 right now. So you may end up getting a check for $56,000. And because that is all paid to you in 2024, it's all going to be reported on your 2024 return. However, if you look at the way the formula works, having that much of a Social Security benefit in 1 year means that a high portion of it's going to be taxable. So with this lump sum election, what you can do is instead say, well, what part would have been taxable if I had gotten it in the year that I deserved it? So if I were not working at all in 2021, 2022, and 2023, then I can say, well, none of my benefits would have been taxable if I got them in the year that I was supposed to. Or maybe only 25%, or some smaller amount. So this lump sum election allows you to go back and refigure the taxable part of your Social Security benefits. What you don't do, you don't go back and amend your old returns. You don't go back and say, oh, I'm going to claim $14,000 in Social Security benefits way back on the 2021 return. Still claim it all in your 2024 return, or the current year return, but you have to add these worksheets, lump sum election worksheets, to reduce the amount of your taxable Social Security benefits. And when you prepare your return, when you fill it out, if you are making that determination, you would actually just write the word or the letters LSE on this area right here next to the text box. So the pre-filled forms don't really have a spot. So I guess maybe you could also do this. Something like that. To say my Social Security benefits are less than the standard formula because they're retroactive. Any questions now about Social Security benefits?